Good morning. We will start the meeting. Okay. What we have seen is even though the market remained volatile, okay, the market remained volatile, but broader market still holding. We have seen that mid and small cap not corrected that much. Global economy is slowing. Mainly the China and US are showing the sign of some slowdown. And India, the FPA, the foreign portfolio investors turned sellers. After last 2 months, they were buyers. So now they have turned the sellers and they have sold a very good quantity in September and October. And finally, the monsoon ends near normal. The first prediction about monsoon was that it will be below normal. But in some parts, South India and Northeast, there were some deficit. But overall, in monsoon ends near normal, little below the normal long-term average. If you see the markets, Nifty ended around flat only, 0.3% down, and Sensex 0.4% only. The mid cap has corrected also 0.2% only. Sorry, mid cap corrected around 1% only, and BSE small caps has corrected around 0.2%. So overall, the market remained flat for last 1 month. So one of the latest development in global scenario is the West Asia conflict or West Asia turmoil. There was a conflict between Israel and Hamas of Palestine. That has been a conflict in local area only. If it spread to other countries or some other countries join, some world countries also join in the fight, means there will be impact in the global markets and global economy. Now there was not much impact, or some 1 or 2 days there was corrections. But if it spread to other countries, the conflict spread to other countries or major countries joining, means it will have a little more impact in the global markets. The impact on crude oil prices we have to see, because if more countries join the flight and there was a destruction from the Gulf oil, and there will be some rally or some impact in the crude oil prices, and prices will go. Yesterday there was a rally in crude prices around 4%. Yesterday the crude oil rallied around 4%. This is the volatility in crude oil prices, but we cannot compare it with previous situation. In 1973, the crude price was quoting around $24 only. Then it went up to around $75. At that time, there was a great demand in the global economy. During 70s, the economy was booming. But now the global economy are in a recession mode, or there was slow growth only. So demand is coming not that much great. So that is one of the factor affecting the crude oil prices. So if there is a little demand, or there is a comparing with 1970s, will not rally that much. In 1973, it is rallied around 300% or 400%. And on another major important thing, US is not now depending on the Gulf oil. And during in previous years, the US was importing around more than 10,000 barrels per day. But it has now become almost net importers because they are almost exporter. They are importing around 2,500 barrels per day. Even though they are importing oil, they are mostly importing from Canada only. So now the US is not so depending on the crude oil. They have almost become self-sufficient after 2000. From 2000, they have built up their reserves, and from 2020, they became net importers, or they need not import from the Gulf area. So Gulf oil mainly depend on India and China demand. But in Indian case, we are now importing more oil from the Russia also. So Russian import has gone up significantly from January to September. So we are India also trying to spread or diversify our imports from various countries. So considering these factors, there will be short-term rally in crude oil prices if the conflict escalates, but it will not be like 1970s situations. So it will go up to maximum around $100 and $105 if the scenario become worse. But it will not go like in 19 like 300% or 400% like that. So that is one of the factors which is important to India that we have to look into. And if you see the global economic slowdown, there was a slowdown in almost all countries. China is mainly slowing down due to its real estate crisis because they have built the real estate properties beyond their demand. So most of the large real estate properties remain vacant in China. So they have some report tell that they have almost built for next 20 to 30 years. So the real estate is slowing down there. There is more supply and less demand. And also US is expected to slow down due to higher interest rate because we have seen that in US the economy rallied mainly due to low interest rate around 0 to 1% only. And also market has given very good return during from 2010 to 20s era, mainly due to low interest rates. Now the interest rate is going up, so there will be an implication in the of interest rate in the economy. So IMF has predicted that US economy is going for a soft landing. There will not be any hard landing or a sudden crisis in the economy. It will be a slow process only. So the market will be range bound or will come down, will not fall that much, or it will not the market will not have a steep fall like 2008 or like that. So there will be corrections, but it will be small and range bound only. Although our exports are weak for the past few years, indicating our exports are already weak, indicating a weaker economy. If the global economy is robust, our exports will grow. But if the economy is weak, means our exports also will be weak only. This is the IMF GDP production for various countries. So first thing is the world GDP growth. World growth previous year was around 3.5%. Now it's around 3% only. In 2023, projection is around 3% only. Next year they have projected only 2.9%. So next year for 2024, there will be a slower growth than 2023. And US also is predicted to grow less only. This year, it is projected to grow around 2.1%. Next year, the growth will be only 1.5% only, 1.5%. And China, if you take the example of China, means China is also going to China is now growing around 5%, expected to grow in 2023 around 5%. Next year it will grow around 4.2% only. Only exception for global economy is India. India is projected to grow around 6.3% this calendar year. And next year also, our country is going to grow around 6.3%. So India is one of the global economy, large global economy, and there will be a little impact on slowdown. So this is one of the recent development. The US 10-year bond yields are shot up to around 5.14%. It is mainly due to the large supply of bonds from So it is mainly due to the large supply of bonds from both US Federal Reserve or also from US government also. So US government has a large fiscal deficit. So they are raising fund by selling bonds. So there is a huge supply from the US government. Also, the US Fed is now selling bond on quantitative tightening. Previous, it was about quantitative easing. Quantity easing means they tend to buy bonds from the market. Now they are quantity tightening because they are selling. They are also selling bonds. So there will be a supply from both US government also from US Fed Reserve. So there is a large supply of bond. So bond prices generally will come down, and also that is why the bond yield keep rising. And also the countries like China and Saudi Arabia are also not interested in rising, in adding more dollars. They have enough dollar reserves for Saudi Arabia as China. So they are spreading to other, or they are diversifying to various asset classes like other currencies and also gold and commodities. So dollar demand is also weak as a part of reserve from various countries. That is why dollar remain a little bit range bound, and so that also indicate higher bond yield. So this is the graph representing the physical deficit of US and also US Fed Reserve quantity easing. The red graph indicating the higher physical deficit of the country. It is coming negative. So they are selling the bonds, and also the quantity easing of the Fed Reserve also in negative area. So both the US Fed government and also US government and also the Fed Reserve both are selling the bonds in the market. That is why there is a great supply of bonds in the market, and also there is a rise in the bond yield. If you take the recent developments in the Indian markets, the various commentary from the various managements regarding consumption versus capex. There are FMC companies, most management are telling that the consumption is very weak, and there is not much strong demand from the general public or from the retail public. So they are always indicating that there will be a slowdown in the consumption from FMCG and various fast-moving goods. So, but the investment continues to remain strong, mainly due to capex from the government. So, government has increased capex, capital expenditure for the last few years. So, mainly Indian economy is now mainly driven by the capital expenditure by the Indian government. This is the government spending, the Indian government capital spending as a percentage of GDP for the last few years. From 17 and 18, it has coming down from nearly 2%. It has come down to 1.5%. Then it has slowly gone up. From 2020, it has gone up to from around 1.5 to 1.5%. Now it is around 3.5%. So it is slowly going up. So as a percentage of GDP means it's a very huge sum. Government is mainly spending on various capital expenditure like infrastructure and everything. So it is mainly now boosting the economy. If the government continue to spend more in capital expenditure, our economy will remain strong only. So this is one of the main factor that keep our economy strong. And most of the public sector bank and also private sector banks are rallied very good. So one of the major positive thing about the public sector bank and mainly and also the private sector bank is the default rate has come down very low. So if you take in during 1990 during 95, 96, 97 period, there was a great percentage of default rate, around 10% of the loans went default. So NPA has risen very high. NPA was very high during 2003 to 8 period. Our economy was growing, and most of the companies are the growth in profitability, earning growth was around 25%. So most have very good cash positions, though the default rate was very low. So after the 2008 crisis, slowly the default rate has gone up, mainly in infrastructure and power related stocks. So the default rate has gone up, and the NPA has shoot up in most public sector bank. So bank balance sheet remained weak in that period. And slowly up to 2020, the default rate has the most of the balance sheet has cleaned up by the bank, and also the new process of RBI, like in calculating NPA and making a database like that, it has helped also. So now the NPA level has come down, and mostly the default rate also come down. It was around 1% only. So bank has less NPA means they do not have to give accommodate for more provisions. So the provisions will be less only. For gross NPA, they will add provisions, and it will be net NPA. Net NPA will come. So provisions will come down means profitability will be increased. So profitability will increase means there will be a re-rating of the banks. So that is why most of the public sector bankers are going up, because their balance sheet has become clean. Also, the default rate has come down, the NPA level has come down. So it will an impact on the profitability of the company and the margin of the company. So that is why if you take the most of the public sector banks before 2020, they were range bound only. Now they are going up, and if the economy also support means we have a very good economic growth also, the credit growth will be good, and the NPA level will be less means the profitability will be very good, and banks will generally give very good return in the coming years. If you take the corporate credit quality, these are the major rating agencies in India: CARE Rating, India Rating, ICRA, and CRISIL. So if you take the example, there are 2 upgrades for 1 downgrades. So if your CARE Rating is around 217 upgrades are there. For downgrades, it is only 130 only. So the credit ratio is around 2%. India ratings it is around 2.6%. Because that means for one country downgrade, there are 2.65 companies upgrading. So more companies are rating agency are upgrading more companies than downgrading companies. So it means that the credit quality of the corporate level is good, and it will have an impact on credit growth also. Because if I have a very good credit quality means banks are willing to lend more. So I will get more loan from the bank, and also I can invest more. So this is one of the good indicator of the Indian economy, that credit quality is very good. The mutual fund flows are very good. Mutual fund flows comes mainly in lump sum and SIP mode. If you take the net equity flows, that means by purchase and redemptions, it is around. And the previous month, the data came around 14,100 only. So it is almost positive for the last 2 years. From March 21, it remained positive. Before during this COVID period, there was large redemptions. This red indicates negative inflow. That means it's outflow. So from March 21, we have a net inflow levels. But one of the positive factor affecting Indian mutual fund industries is the continuous rise of SIP contribution. In by the method of SIP, SIP method, when the net investments has grown up to 16,420. So during April 20, it was around below 10,000 only. So it touched 10,000 during 2023 only. So now it's around 16,420 crores. The last previous 2 months during August and July. This is the 16,000 is for the September figure. It was more than 15,000. So it is slowly going up from around 8,000 in 2020. It has gone up to 16,000. So within 3 years, it has doubled. So 16,420 means we have around 22 working days in a month, excluding Saturdays and Sunday. So averagely 7,500 crores coming every day. So that is one of the major factor which are holding the market together. Even FI are selling means our domestic institution like mutual funds are ready to buy. During 2008, our mutual fund industry's contribution was very low. So FIs sold means the market has come down. So now the FIs are selling means as mutual funds have very good inflows, they keep buying. This is the this is a graph of both FIs and domestic institutions. Red indicate domestic institution inflows, and FPI inflows means negative only. So now if you say the how much they sell means almost that that amount the domestic institution are buying. So if you take these 3 months like May, June, July, or even though FPA are buying, domestic institution was selling little bit only. So when FEA for fraud, FI is selling means domestic institution are buying. So it is keeping balance of the Indian market. So we have very good mutual fund inflows that will keep keep the balance when FI are selling. This is FI flow for the last 10 years. From 2011 to 15, they were net buyers, and 2016 they were sellers. In 2022 and 23, they were sellers, but market has not come down mainly because our domestic institution are buying. In FI 24, they have bought almost $17 billion from April to September. Now the domestic institutions, the market is not mainly dependent on the FI. This is the one of the data during, if you take the example in this 2008 and 2012, calendar year 2008 and 12, we have around $58 billion of FI flows, but our flows with the domestic institution was only 12 billion. So it was around 0.2% of the FI flow. The domestic institution constitute of about 0.2% only during 2008 to 12 and also during 2013 to 17. But from 2013 to 2023, the domestic institution has more flow than the FIs. FI flow was around that 10 years. FI flows was around 83 billion only, but domestic institution flow was around 93 billion. Now from if you take 18 to 23 means from calendar year 2018 to calendar year 23 means it was around 2.4 times. The FI flows was around 33 billion only. Now the domestic institution flow was around 81%. So now the domestic institution flow is more than the FI flows. So last 2 years, 3 years from 2020 to 23 means it was around 2.5%. The FI flow was around 24 billion only, but our flow, domestic institution flows were around 59 billion. So it is mainly because of this domestic institutional flow, the market is keeping moving ahead. Now for calendar year, it was neck and neck. The domestic in the foreign portfolio flows was around 14 billion, and our domestic flow was around 16 billion. Another important thing, monsoon ends nearly normal. Monsoon has first the most of the market predicted that monsoon will be very weak. So finally, the monsoon end with near normal. There was a little bit rain during June, from June to August, but July and September saw a very good rainfall. Overall monsoon not bad considering the El Nino, because all the IMD and also SkyMet has predicted that we will have a below monsoon, mainly due to this El Nino effect. But it was overall a near normal monsoon. This is the spread of the last 6 years monsoon performance. 2018, we have a net deficit of around 9%. And from 2019-20 and 2022, we have a surplus monsoon. And 2021, we have a minus of 1% only. Now we have minus of 6% only. This monsoon rainfall generally calculated from June to September, June 1st to September 30. So we have a net deficit of 6% only. This is the data of GST collections for the last few months. So it's coming mainly above 1.5 lakh crores. So it's around more than 1.5 lakh crores. It's generally coming. And last few years also it is slowly coming down to 1.6 lakh crores. Around 1,62,712 crore was the GST for the last months. So it is mostly coming around above 1.5 lakh crores. So government of India is considering around 1.6 to 1.7 lakh crores. So it is coming for the last 6 months. Generally, April tends to be higher amount. April came around 1.87 lakh crores. So generally April tend to be higher. If you take all the other months, it was above 1.5 lakh crores, nearly 1.6 lakh crores. If you take the IPO process, fundraising through the IPO, so even though the number of IPOs is greater in last few years, the total amount collected was the total amount collected the total amount collected was less. It was around 27,435 only, but the number of IPOs coming was around 49 IPOs came, because more number of IPOs are coming, but the amount rising is small only. So there were no big IPOs. So number of IPOs coming means more companies are listed. That is one of the positive factor. Even though then we see around 4 to 5 IPOs every week, the amount raised was very low only. And also the percentage of fresh capital is means in IPO there will be two amount of fundraising will be there. One is offer for sale. Offer for sale means the existing promoters or private equity players will sell the shares, and second part is fresh issue. Fresh issue means the company, the fund will go to the company. But now the last IPO in 2023, there were 35 IPOs, but 49% of the fund goes to the company only. If you take any example in 2020, even though there were 26,000 crores raised, only 13% were fresh issue. Most of the companies like Zomato, Paytm, most of that type of company, most of the IPO came were offer for sale only. The promoter were selling at the high end of the market. So the IPO trend is not that bad. It's also good also, because more companies are raising fund. The rising fund is not large, like 1,000 crores, 2,000 crores only. So not LIC, like LIC, the IPO came around 20,000 crores like that. So most of the IPOs are only small amount only. And also, most of the fund is going to the company only, not offer for sale. So generally, what investor should do is, this border market tend to see volatility. So there will be volatility mainly due to short-term trend is like the conflict in the Gulf region, and second part is this slowdown in US. So most economy like US, China, and Europe are most of them are expected to slow in the next year in 2024. So there will implication on the sectors like IT, because IT is catering to the export sector in US and UK. So there will be some range bound market in most of the IT stocks. So there will be implication, and if after 2000, if economy begins to grow, means these companies will give very good return. So we can buy during corrections. We can add these large cap companies during corrections. So we have to be selective in buying mid and small caps, because some companies are going up like anything. So there are still pockets of opportunities are available in Indian market. So we have to be careful in identifying and investing in these companies. So the overall there will not be any sharp corrections in the market. There will be some corrections because due to short term and long term slowdowns. So we can use this opportunity to buy these companies. The data to watch is Q2 result and also the movement of crude oil. As I indicated in the previous day and yesterday, the crude oil has rallied around 4% due to this crisis in the Middle East. So now we will look into the recommendations. The first company we are recommending is Tata Motors. The Tata Motors, in balance sheet, they have become net cash flow because previous year, due to high debt and investments in JLR, the cash flow was negative. This month also, manager indicated that this quarter result will be cash flow positive. Previous quarter was also cash flow positive. So once the company become net cash flow, that is positive cash flow, means there will be a re-rating in the company, and also they are aggressively going in vehicle scenario. Also, its subsidiary company Tata Technologies IPO will come within 1 month, this month, or it will come early next month. Most probably it will come this month. So there will be a movement in the Tata Motors shares. Yesterday also it has gone up. So one can buy at current market price with a target of 750 rupees. And next is Coal India. Generally, due to power shortage in India, we have a great now the demand for coal is has gone up very significantly. So there will be demand in coal, and also the power demand will not go much down. So Coal India has remained range bound for few years, from around for 3 to 4 years. Now it is going up mainly due to demand in coal. Also due to heavy monsoon in previous years, the coal production or coal mining was lower. And now the coal mining has picked up, and also demand has picked up. So we are seeing a very good movement or also appreciation in the Coal India stocks. So one can buy at current price of 308 and with a target of 350. Also, Coal India generally give very good dividend also. It's a very good dividend company, so one can hold it for dividend also. And third one is Coromandel International, the Murugappa Group company catering to the agriculture sector, fertilizer and insecticide fertilizer for crop production also. Now we earlier the prediction about monsoon was below normal. Now it has just ended as normal. So there will be demand for agricultural product like fertilizers. So one of the company with good management and good execution is Coromandel International. So one can buy Coromandel International around 1,150 with a target of 1,280 levels. Another company is PNB Housing Finance. The NPA of PNB Housing Finance was very high. Now the private equity players has entered in the company, has taken good stake in the company. So most probably they will try to turn around the company, and the NPA level has come down very drastically. So also there is a housing demand in the Indian cities. That is why most of the real estate companies are going up for last 1 month. So generally affordable PNB caters to the affordable and mid-size segments. So there is a very good demand after the COVID period. During 2020-21, there was a sluggish demand. Now the demand is slowly picking up with the festival season, mainly in Western and North India and Eastern India. So it is going up. So we see very good rally in most of the housing finance companies. So due to this higher NPA in the past, the PNB housing is quoting at attractive valuations. So we can buy at the current level. So once in turnaround means it will be valuation will be very good. So you can buy it. So another form, another company is IGL, Indraprastha Gas Limited. So now the government is going to bid for most of the city gas distribution companies in various cities. So IGL is one of the most significant player in the city gas distribution. Mainly, they are doing city gas in Delhi area, NCR, National Capital Region. So they will bid in most other cities also. So city gas is one of the developing or growing industry in the India. So it has a very good potential because only handful of cities are having city gas distributions. So when the government going to have under very city product like smart city, various city products, so they will go for city gas services in most cities. So IGL is being one of the best player. They will bid and have a good success in that bidding. So you can buy in the IGL gas also. And one of the city gas distribution companies IPO is going to come this month also. So there will be some movements in the city gas companies like IGL and Gujarat Gas also. So you can buy IGL at current price of 472 with a price target of 530. This is a September month view. Reliance, we have given Reliance, Crompton Consumer, ICRA, and also JM Financials. So most of us come down after the our recommendations. So our portfolio has come down around 3.6% only. But the Nifty has come down around 0.3 only. So our portfolio has underperformed the Nifty, but you can hold Reliance, Crompton Consumer, ICRA and JM Financial because they are a good company. So we are generally given recommendation with a 6 months view only. So you can hold it. It will go up once the market stabilizes.